Welcome to Wall Street Week, the show of record for long-term investing. I'm Gary Kaminsky.
And I'm Elizabeth McDonald. President Trump taking steps to roll back key components of the Dodd-Frank banking bill. Wall Street cheered the news, but watchdogs jeered. Our very own Maria Bartiromo spoke with White House Chief Economic Advisor Gary Cohn in a First on Fox Business interview.
The biggest thing that we have to fix is that we have to get the United States banking system working again. We need to make capital available for small and medium-sized businesses and for entrepreneurs. Today, banks do not lend money to companies. Banks are forced to hoard money because they're forced to hoard capital and they can't take any risk. We need to get banks back in the lending business. That's our #1 objective.
Powerful stuff. Lots to get into on this issue. And who better to ask than Nuveen Asset Management's Bob Dahl, along with Shaffer Asset Management CEO Dan Shaffer. EMAC, great to have you here.
Good to be with you. Loving it.
So, Bob, this is what the market wanted for the last 2 weeks. The market got it on Friday morning. Is this what they needed?
I think so, among a bunch of other things. We need to continue to see regulatory rollback. The financial stocks we know came to life in the second half of last year, and they will continue to do well if we have a little more economic growth, a little bit higher interest rates, and rolling back regulation. Free it up. Gary Cohn just said we need a healthy banking system, one that's out there lending again to get the economy going.
Yeah, Dan, to Bob's point, I mean, the banks were like in a mini ice age, right? And it was stranding, you know, the Russell 2000 guys, the small businesses, and investors, that Frank fiduciary rule, right?
Right, and you can see this in the velocity of money index, because that means they're hoarding the cash, they're buying treasuries, they have to keep this surplus reserve just in case something catastrophic happens, and they've been under this lockdown since this Dodd-Frank Act took place, which to me is a joke. I mean, these are the two guys that allowed the financial crisis to happen in 2006. They told the banks, anybody who can pass a mirror test, get them a mortgage. And then when the whole thing crashed, these guys came to rescue. So it's like the firemen lighting the fire and then coming out and put it out. And that's how I viewed this act, which just locked up not just the banks, but people learning and understanding investments that could be to their advantage, because they need to be sold products. People don't just buy. They need to be sold, and people in the business need to be compensated properly for that.
Yeah. Let's try to explain, Bob. Could you explain to the viewers who hear about this but might not understand, what does it really mean if this rule that was supposed to go into effect in April, a lot of the industry lobbied against it. If it doesn't happen, what does it mean to the average investor?
It just frees up financial advisors to try to do what they were doing and hopefully what's best for the clients. Look, there was a good reason to do this. Financial advisors need to do the right thing for the consumer, and that's what the intent was. But it went way past that, almost requiring you, in some financial advisors, you got to buy the lowest fee product that can only own index funds. This will free financial advisors to be a little more relaxed and go back to doing what's right for the customer.
You know, my take on it all along was that if the financial advisor wasn't doing the right thing for the customer, guess what? The customer was going to go find another financial advisor.
Right.
That's called capitalism.
Right. That's exactly right. And so, Dan, basically the bank regulators were acting like safety engineers. They were too much in investor choices, right? And it stranded investors, to Gary's point. The Dodd-Frank fiduciary rule just said you got to make sure you get your client the best advice. So what is that guy going to do, that broker or private banker? They're going to say, I'm not going to get cracked down. I mean, on by a regulator, right?
Right. But even if it goes a step further, now this is too much protection that's going on for these consumers, because it doesn't allow a consumer who wants to take risk in a product and put money into the system for investment, because the fiduciary rule would prevent somebody from saying to their client, hey, you know what, I've got an idea here, it's a little riskier, but it could give you tremendous returns down the road. They're all afraid to do that because of the act, because they're going to get sued. I mean, the E&O coverage for errors and omissions went through the roof, and the firms wouldn't allow some of the brokers to sell certain products. Yeah. It really constricted.
Let's talk about investing in financials. Dan, when you joined us last year, you did not like the financials, and for a while the financials were very much dead money. But since the election, financials have had a great run.
Yes.
And obviously, in terms of the higher interest rates that are being forecasted, it's been a major beneficiary. Do you like the financials now?
No, and I was wrong on that call for the time period. I believe that interest rates are going to go down dramatically.
You do.
And I think the banks went up because of that.
The
I didn't
anticipation.
foresee that kind of a run in interest rates so quickly. It was a panic bailout. But my indicators are pointing that interest rates are going to go down, the 30-year and the 10-year yields are going to drop dramatically, and the banks are going to go into the same crisis that they went to before.
Okay, let's stay on that point, Bob, because it's an important point, because interest rate hikes are really kryptonite, right, to the markets. They go, whoa, and remember the Fed forecast at the beginning of last year, 4 rate hikes, we didn't get that. So just to take the other side of what Dan is saying, what if we get into a trade war and China theoretically stops buying our bonds, yields could spike? What if we get a tax cut? That means the government has to borrow more, right, to offset, to finance itself. Do you see, in both those scenarios, do you see yields going up and the market going down?
Yeah, I think the overwhelming question is going to be, is the economy doing better? Are we going to get more nominal growth, real growth plus inflation? And I think the Trump fiscal policy is designed to do that. We also have to remember that in November, when we're all busy with the election, we got October economic statistics. They were a little better. And then November was okay, and the pattern goes. So we are seeing a little better growth. I think wage rates will continue to move higher. All that, in my view, will push interest rates higher.
Yeah, but to Gary's point, I mean, Donald Trump is one big black swan event, right, Gary? I mean, so go ahead.
Yeah, so assuming we get some of this regulation, we're going to get more nominal growth, some more real growth, units, productivity, and probably some more pricing, more inflation, more nominal growth. We may see U.S. nominal growth in 2018 at 5%. We haven't seen that since the Great Recession, and I think that means interest rates drift higher.
Just to wrap it up on the financials as a sector, so Dan, you would say use any of the strength that you see right now in terms of the regulatory relief to sell these stocks.
Yes.
You agree with that, Bob?
No, we think there are 3 necessary conditions for financials to continue well. And today's a good day. Less regulation. But we need the higher interest rates and the better economic growth.
So if he's right,
he's right on the banks.
On the rates, yeah.
I hear what you're saying, but there's a big disconnect here. We have unemployment, if you use the numbers they're using, at a very low rate. We have the velocity of money that's collapsed, and we have a debt to GDP of 105%, which is higher than the 37% or 50% that it was in the last 15 years. This is going to slow down growth. Trump's tax policy is also going to bring less revenue into the government. And he's now negotiating deals with corporations of which the government purchases from. Who's the biggest purchaser in an economy? It's the government. If we pull back tax revenue and we pull back government spending, that's going to slow down the economy, and that's why interest rates are going to go lower.
Bob, wait there. Gentlemen, stay right there. We're going to get into whether or not Dan is right about the economy in terms of earnings and what it means for the market. So, guys, stay right there. Wall Street Week will be right back.